demographics are very important, and India has more Gen Z than China and the United States combined. I like to say, increasingly, I'm saying that India is like the perfect emerging market. What is an emerging market? What are you hoping to find in investing there? First is big. They have a lot of people. Well, this April, India is now the biggest population. They're young people.
India. It's one of the best places in the world to invest in. This is Investination India. It's your chance to learn why investing in India is a home run. You'll get actionable tips on how to invest, ways to invest, where you can invest, public and private markets, venture capital, private equity, angel investment, startups, and technology. There's a lot to cover, so let's do this. This is Investination India, and this is your host, Manish.
Kevin, good morning. Here we always talk about tactical opportunities to invest into India. And thank you for becoming the guest in this and talking about what your experience has been about investing into India, what you're trying to do, and your experience. So, why don't we start with a little bit about yourself?
Sure. Well, thanks first for having me. So, my story goes like this. I live in San Francisco. I've lived here my whole life. I'm actually 15 miles east of San Francisco. I did move away for college for a few years, but I graduated 30 years ago and returned to San Francisco. And I started with one interview. I had one interview in downtown San Francisco a few weeks after I got home. And frankly, we talked about college basketball for the first 20 minutes of the interview. And then after that, the person said,
You must be wondering that what's happening. Is this really an interview or they just want to throw me out?
well, I don't know. I think he had been a basketball player, and the school I went to was the best basketball team back then. So that was a common interest. But anyhow, after we talked
Yeah.
about basketball, and then he gave me a simple description of the different jobs in the business, and then he said, "You can start Monday." And I said, "Well, how could I start Monday? I don't know anything about investing." And he said, "Well, then you should go and buy this book and read it over the weekend." And he wrote down on a piece of paper a random walk down Wall Street. And I stopped at the bookstore on the way home. We used to have bookstores. We don't really have bookstores anymore. But the bookstore that I purchased the book at is now a Tesla store. And across the street from it is an Amazon bookstore, in all irony. But so that's how I started, was reading about indexing. But I quickly realized that when it came to investing, I was not really an indexing person. I was more of a, Charlie Munger, Warren Buffett wannabe. I was a quote unquote value investor, or trying to become one. And so, as I tell people, I pray towards Omaha. But that book, A Random Walk Down Wall Street, remained on my shelf, and I referred to it multiple times in the coming years. In a very random way, I ended up meeting the author in 1998. His name's Burt Malkiel.
How did you meet him?
Well, in early 1998, I was this young, cocky value investor and thought that this company, Amazon.com, was outrageous. It had $1 billion market cap, and all it did was sell books, and you could buy, Barnes and Noble for the same price, and it had real, revenue. And so I thought I was smart. I was going to short Amazon.com because it was so overvalued. And I did that. And I lost about a third of my net worth in one day. But the same day I saw something. I saw a different company change its name. The company was called KTEL, KTEL, which sold, record albums. And they changed their name to KTEL.com. And the stock went from $1 a share to $30 a share in one day. And I said, oh my gosh, I've read about this. And so I went to my bookshelf and I found my copy of A Random Walk Down Wall Street, which had been, pretty well marked up at that point. And I found the chapter in the book about bubbles and stock market valuations and extreme valuations. And there was a quote from the 1960s from a man named Jack Dreyfus, who had been one of the big mutual fund barons. And in that quote, he said, this was a quote again from like 1970. He said, take a company called Shoelaces Incorporated, change the name to Silicon and Electronic First Burners, which were the the buzzwords of the time, Silicon Electronics, and the stock would go from 8 times earnings to 64 times earnings. And I said, oh my gosh, this was a quote from 30 years ago, or whatever it was at the time. And I said, I have to call this guy and tell him that it's right out of the book, as we say. And we had the internet back then in 1998. It was pretty new, and we had a search engine. It wasn't Google. And up came his Princeton website. Basically, he had just a landing page with his picture and his phone number and email address and office hours. And I picked up the phone and dialed the number, and I think I thought I'd get a secretary or something, but he answered the phone. And I said, well, gee, Dr. Malkiel, I don't know you, but I read your book and you should see this. This company just right out of your book. They changed their name. The stock went from $1 to 30. You could take, and I actually did this with my copy of Random Walk Down Wall Street. You could cross out, Shoelaces Incorporated and fill in ktel.com, or put in ktel and then cross out silicon and put in .com. And it was like, this is exactly what just happened. And he was really nice. I thought he really liked me, but it turns out, now that I know him pretty well, he's just a really nice person to everybody, which is one of his many amazing qualities. Working together ever since 1999, and that was just the beginning. And we've done a bunch of stuff. And he ended up, basically pulling me into China and then India.
In fact, for our viewers, it would be good idea to really know that Bert had been the father of index funds in US. Maybe Kevin, you would like to take us through about what he wrote about index funds.
The story of index funds is a very interesting story. And, one of the things that happened, in the 1960s and before that, but let's say this is in the 1960s, is, all of the mutual funds were actively managed mutual funds, and they had, relatively high expense ratios, as is still the case today. At the end of the year, people would say, well, none of these funds beat the index. And people would say, well, you can't buy the index. And so there had been, I think, probably a few people that were talking about the idea of, well, why not? And when Bert Malkiel wrote the first edition of A Random Walk Down Wall Street 50 years ago, he wrote that he had a suggestion. And his suggestion was that somebody put together a fund that owned all of the stocks in the index and didn't charge a management fee, or at least charged a very, very low management fee. And he referenced the fact that people say, the mutual fund salespeople tell you can't buy the index. And he wrote, it's about time that investors can buy the index. And then he suggested in the last paragraph of the passage that the New York Stock Exchange should start this not-for-profit index fund, and that if they did not, that he wished somebody else would. And then the New York Stock Exchange did not launch the first index fund. Burton's friend John Bogle launched it a couple years later, and Vanguard and indexing were born. Because ultimately, investing is really, if you really break it down, its best elements, it's just simple. And the first thing is, in terms of investing, is you need to do it. You need to start when you're young and save. And whether that's $100 a month or $500 a month or $1,000 a month, that's what you need to do. And just do it over and over and let the miracle of compounding work for you and get the most return you can get. And if that means cutting out the billionaires in Boston who have been charging you 1%, then do that. But the problem was that if you had $100 a month to save, or $500 a month, or even $1,000 a month, you couldn't invest in the stock market. You had to buy a mutual fund, because back then you had to buy 100 shares of stock to do a trade, and the average stock was $30. So that meant you needed $3,000 to buy one stock. And that would, and by the way, the commission on that would be $29. That was the cheapest commission from Charles Schwab.
Yeah, and we are talking about which year? 1990s.
This is 1999. And I decided that we needed to develop a way for people to invest into the stock market with smaller amounts, with $10. And so I created the first fractional share. I developed a system and filed a patent on fractional share trading.
You still own that patent?
No, the patent was filed, and then we were acquired by E-Trade, in the year 2000.
So Kevin, it's an amazing thing. I think you are the founding father for fractional share ownership in
Well,
US or in the world, if
I'm
I can say
definitely
so.
one of them. There were other people. Again, unlike a lot of these things, there's other people, kind of noodling around. There's people that hear your idea and go do it. And so, but I definitely was there, and I believe I am the first one to develop and file a process patent on fractional share brokerage, which is now pretty mainstream, and it's just it's a way to liquefy the stock market and cut out layers.
No, absolutely. It creates a lot of liquidity in the entire marketplace.
It creates a lot of things that I thought would be good for the world, and I'm intellectually thrilled to know that pretty much everywhere now you can do that.
So effectively, you have been, along with your partner Bert, had created some very institutional landscapes in the world.
Well, we did two things. I mean, there were two very distinct things we did in terms of the call it the investment digital public infrastructure. It was the fractional share brokerage. And then after that, we started another thing that's become a pretty big deal, 20 years later as well, which is called direct indexing, which has gone mainstream as well, it's got a bunch of different, the main thing they call it now is direct indexing. Schwab calls it personalized indexing. But when we created it in 2002, we called it active indexing. And the idea was that, okay, now that we've got the plumbing and we can do fractional shares, well, what's the best way to buy stocks? Well, you could take the Omaha view, and I have that view, but that requires a whole lot of things. Or you could say, okay, let's index and continue with why that's a good idea to do. But rather than buy an index mutual fund, why don't we just have our own brokerage account with 50 stocks that's managed like the index?
I think, Kevin, now that we have established that you and your partner have been always be at the forefront of all this intellectual as well as strategic directions about the industry. So how did you get into China or investing into emerging markets?
When you have a new idea, there's always a lot of people that say, well, why that doesn't make any sense. No one's going to do that, whatever. But so we sold the company to Natixis Asset Management, which is a big Boston-based mutual fund company that bought the business. And we sold the company. It was December 2004 that we were acquired. But a few months before that, Google went public. Before the IPO, they invited my partner, Bert Malkiel, to give a talk to the employees about investing. He was well known as sort of the champion of the individual investor, and he had some relationships with board members from Princeton. So before the IPO, he was invited to tell all these Google's employees like how they should invest, like what they should do or not do. And I didn't go to that event. I wasn't invited, but a few months later, I got a phone call from a person at Google. And I said, well, who's your advisor? Because, we didn't work with individual investors. We were, more of an institutional firm and worked with Morgan Stanley and advisors at other places we worked with, but not with individuals. And I tried to, set him up with an advisor. And he said, no, I don't want an advisor. I know what I want, and I don't want any additional fees in there. And so can I just invest directly with you? And I was hesitant, but I agreed to go down and meet him down in Mountain View. And I sat down with this kid. I was probably 31 or 2, but he was like 25. And I said, well, here's how we do this. And, so on and so forth. And he said, okay, I want to invest in this. How much should I put into this active S&P 500 strategy? And I said, well, it depends on how much money you have. And he told me he had quite a bit of money. And I said, okay, well, that's good. So you're rich, so you should be conservative, but you're quite young, so you should be aggressive. And, I don't have a pie chart, an asset allocation pie chart in my pocket, but maybe 20 or 25%. And he said, okay, well, what about the rest of my money? And I said, well, I don't do that. And he said, what would you do? And I said, I would probably just buy a bunch of ETFs for the rest of the asset classes. And then he started introducing me to other people at Google. So this is in the beginning of 2005. But when I'm doing this, Burton starts going to China. 2 of his Princeton economist friends were Chinese, and they had been offered a lot of money to go back and teach economics in Beijing. which they did. And they started to call Burton and say, hey, Bert, come look at China. Like, this place is really booming. We are completely adopted capitalism. And so he's going back and forth to China. I'm going back and forth to Mountain View. And he writes a white paper with these two guys. And it gets published in the Journal of Investment Consulting. And the Google people called me and said, hey, can Burton come talk about investing in China? And I said, okay, next time he's in town, we'll come down there. And 18 years ago, we got it. I left San Francisco. I think I picked Burton up. He was on the board of a biotech company down by the airport. So I picked him up down by the SFO airport, and we drove to Mountain View, and he talked about China for 90 minutes. And then everyone looked at me and said, we want to invest in China. And that's literally how it started. And I'm still working on that, and it was not planned. Frankly, I kind of resisted it. Burton kept saying, we have to do China. We have to do China. And I said, well, Bert, I've spent a lot of time on the US market. Maybe I should leverage that experience. I'm kind of flat footed on China. But the two main things that I've learned in the last 18 years, why don't I start with that? When it comes to emerging markets, there's two high level things that everybody should know. I will also let you know that I learned both of these things in the first 10 minutes after we got back to the office from Google. Drove back to San Francisco, and I walked straight over to our portfolio managers, and I said, all right, the Google guys want to invest in China. And I said, give me a list of all of the companies in the China ETF. I want to know what are the exact businesses we're going to become owners of. Before they gave me a list, Burton said, Kevin, when you get the list, you're going to see that most of the stocks are government-owned banks and oil companies, that are run by the Chinese Communist Party. Now, that didn't sound very good for probably obvious reasons, but then he went on to give me an example. And the example was, you've got a Chinese state-owned bank, steel manufacturing company with 15,000 employees that's about to go bankrupt. It needs money. It goes to the state-owned bank and asks to borrow more money. A normal banker would say no because you're losing money and you're broke. But the state-owned banker says, well, if you run out of money, then the 15,000 people you employ will be protesting in the streets. And we don't want that to happen, so we'll give you some more money. Now, the only reason any business has value is because it makes profits for the people that own the business. And the only way to grow the value is to grow those profits. The China index, the China ETF was 80% state-owned enterprises. So that's the first problem. The index itself is horrible. All right. This MSCI Emerging Markets Index, which is, unfortunately, that's what everyone points to and says, how are they doing? I'm going to invest in emerging markets. I'm going to buy that.
But then, just to interject you here, that those people who asked you to create or invest into China, they could have just bought China ETF on their own, right?
Presumably they could have, but they had asked me to sort of oversee their money for them. That financial advisors and institutional investors use ETFs more than anybody. So it's not, ETFs are certainly not just for the self-directed investor. In fact, if you look at the Bridgewater, the Ray Dalio's old firm, their biggest positions are all ETFs. We're trying to make better, ways for people to invest in emerging markets, and that's what we've done. I mean, the returns for emerging markets have not been good, but I believe that since inception we have meaningfully outperformed the broad emerging markets index, which again hasn't done really anything. But I remain convinced that if you want to invest in emerging markets, the best companies to buy are the internet companies, which is what we buy. And I think it's still very early. I mean, when you look at what the next 10, 15, 20 years looks like beyond China, because China's had this internet thing. It's happened in a major way in China. China's e-commerce market's the largest in the world. So it's an emerging market in a traditional sense. But when it comes to the internet, it's the most developed country on the planet. But the other 45 emerging markets, India being the largest, those countries represent the third wave. So the US was the first internet wave, China, the second internet wave, and now this third wave's coming. And that, if you look out the next few decades, the amount of growth that's going to happen in emerging markets in the digital part of the story it's incredible. I mean, and it's almost certain to happen. And it's, what people don't realize is, we've had computers here for 30 years or more, and the internet for Well, I guess we've had computers for longer than that, but the internet we've had for 30 years. Well, guess what? Right now in India and places like it, there's millions of people a month getting their first ever computer, which is an increasingly affordable supercomputer in their pocket. That, if we talked 6 months ago, I would have told you could get a brand new smartphone in India for $50. But as you likely know, on July 3rd, the $12 Geo Bharat was introduced, which is cheaper than most, feature phones. So you can now get a $12 supercomputer in India. So the computer's coming to those billions of people and they're getting their first internet access. And, we've had such an evolutionary experience with information and with technology. These people are going from nothing to everything, and their lives are changing in a meaningful way instantly when they get that first magic device in their hand. And because they don't have a bank account, or a debit card or a credit card, and they don't have a
So tell me, sorry to interject here, but tell me a little bit about that. How, why do you think that now India is at the same place as maybe China was when you started this China ETF?
China and India were basically the same size in terms of GDP and GDP per capita. But what was very clear and became increasingly clear every year China got a little bit further ahead of India. And the reason, primarily that was referenced was because China was building the world's greatest infrastructure, and with a one party system that you can get things done really quickly without a lot of red tape and a lot of bureaucracy. And India's GDP per capita right now and its total GDP, they look a lot like China did 15 years ago. Apple opened its first store in China in July of 2018 or 2008, 15 years ago. And right after I left India this spring, the first Apple store opened in India.
Having an Apple store is a signal that you are just at the inflection point.
Yeah, I mean, you've arrived, right? As they say. So anecdotally, we have things like that, but India's demographics look a lot like China's did 15 years ago.
But tell me a similarity in terms of demographic profile.
India's average age is about 12 years younger than China. Demographics are very important, and India has more Gen Z than China. What is an emerging market? What are you hoping to find in investing there? First is big. They have a lot of people. Well, 15 years ago, China was the biggest population. As of this April, India is now the biggest population. They're young people. China's are not as young as they were 18 years ago, and India now has that incredible young population. China had the fastest growing economy 15 years ago. Now India's got the fastest growing economy. 15 years ago, nobody on the planet had a smartphone, right? So India had 200 million China had 200 million PCs 15 years ago, and India's got 400 million, 500 million smartphones now. So all of those things that, when you
So there is a lot of similarity between India of today and China of 15 years back, and that gives a lot of confidence.
in terms of that checklist of like what are the basics, but what makes the story different than China, that I think is what makes it so exciting and the perfect emerging market, because not only does it have all of those basic things, that where we are in the arc of time with regards to personal computing power. I think a lot of Americans are familiar with the Indian outsourcing companies and the people that are, the call centers and what have you. And they know, and investors know that there are these Infosys and Tata that basically have, become the back office for the U.S. corporate America. You don't have to look very far. There's 25 S&P 500 companies have Indian CEOs, including Google and Microsoft. So no other emerging market has anything like this. So going into this, what looks like a sweet spot of just, organic growth for all the reasons I mentioned, you've also got this human capital pool that's unmatched. On top of that, you have the secret weapon in India, which I don't think people really appreciate, which is the digital public infrastructure that no other country in the world has ever had that.
Tell me a little bit more because this is very fascinating what you're talking about. Digital public infrastructure. I think what you're talking about is very similar to what people refer to as smart cities or something like that.
Well, I'm talking about the India stack. One of the things that also contrasting India to China is that India has a democracy. I think one of the reasons I didn't follow these programs very very closely is digital public infrastructure sounds very abstract and it sounds kind of boring. But let me tell you how to think about it. And it's actually incredibly simple. I will almost certainly everybody that's listening today or whenever you're listening, you're going to use digital public infrastructure. First, you're going to use it on the internet. The internet itself is the world's most important piece of digital public infrastructure. It's there. It's behind the scenes. We didn't make it. We don't have to oil it or clean it. It's there. India has made its own digital public infrastructure, and it's a series of digital programs that form a stack. If you think about on a graph, there's various stacks to this infrastructure that do different things, but they interact with each other and they create a platform, a digital platform for the country's growth. The first layer of the stack, if you will, is called the foundation. In 2009, the government of India decided that it finally needed to create a national identity card system. One of the problems in developing India's economy was about 40% of the children born didn't even get birth certificates. So the number of people that had a official form of government identification was very low. And as you can imagine, it's hard to modernize when a billion people have no way of proving who they are. And so the idea was that they were going to finally create a physical card and give everybody in the country their own unique 12-digit number with a photo and a card. And when they launched it, they asked one of the founders of Infosys, Nandan Nilekani, if he would be in charge of the program. Now, he's well known in India and is currently the chairman of Infosys. And he's an author and had written about some of the challenges India faced. And so they asked him if he would be in charge of this Aadhaar program, and he agreed to lead this effort, but he insisted that if he was going to lead it, that every 12-digit number would be linked to a human being with fingerprint scan and an eyeball scan, biometric information. And it was all voluntary, by the way. It wasn't like a big brother, and you were forced to stand in line to give your information over. It was all voluntary. And they launched it in 2010. A few years later, they added another layer to the stack, know your customer layer, KYC. And I may have heard about that when it happened, but I don't remember that. You can walk into a bank with nothing in your pockets, and just with your fingerprints and an eyeball scan, you can open a bank account. So you've taken an economy that had very low financial inclusion to almost 100% financial inclusion, and you've done it in most of it's happened in the last 7 years.
So I think here I just want to, for our viewers, I would like to emphasize that having a bank account and being part of the formal economy opens up so many channels for the citizens of the country, because now they can access credit, they can have savings, they can have investment. So it creates a lot of accelerated growth or impetus to the growth rate of the economy.
Well, it basically accelerates the working capital turn cycles for the whole country, right? And takes out a lot of friction. And so even if it didn't have those features, it would having all of a sudden, everybody paying for things digitally is a benefit. India's economy, which in 2016 was less than 5% digital, and the rest of it was cash, right? And now, 7 years later, it's about 80% digital. One of the other things that the stack can provide is a credit market, because it's hard to get personal credit or small business loans or credit in India. And as Nandan talks about, because everyone that's in the system has a digital track record of, a credit score type of system in which consumers can get credit, can develop and scale.
So tell me, with so much amount of thing, what's the risk in this entire investing into India?
Well, the risks that I see and think are the biggest risks, I think that there's no other organization on the planet that has key man risk as much as India. Modi is the face of this story right now, and he is the embodiment of this story and the leader of the story. And I think that there's no indication he's leaving. He's just finishing his second 5-year term, as you know, and he will probably get a third 5-year term. But and I understand that his top lieutenants are quite capable and good, but nobody's Modi, and he's one of one. And if for any reason he was no longer leading India, I think that would be a risk and challenge. Um, Again, no indication that that's planned or going to happen, but they've had leaders in the past that have left unexpectedly their jobs, and that's historically at least once been tied to religious and ethnic tensions, which I think is the second biggest risk to the country. They've had a 75 or 80 years of racial tensions and ethnic tensions, and Modi is very popular with the Hindu majority, but there's a lot of people that aren't Hindu that maybe don't like him as much. And but you always you have, I mean, there's all sorts of strife and frictions going on almost at all times. Up in the far northeast of India, they've shut the internet down for a few months now as a couple of different groups have been at battle with each other. I don't think there's any other internet economy that's going to have the amount of fundamental growth that India is going to have in the next decade, on a percentage basis. And to the extent that translates into revenue and earnings, I think based on current valuations, I think investors, with a 5 or 10 year, and again, this is all about the miracle of compounding. I mean, I can't tell you what's going to happen this week or this month or, this year even. But if you grow your revenue and earnings at 20 or 25% a year, well, if the multiples stay the same, well, then investors can expect to make 20 or 25% a year. And right now, the revenue and earnings growth rates are both in that range. It looks, knock on wood, you never know what's going to happen, but the setup for India's growth and for INQQ to capture that, I think is quite strong.
Thanks a lot, Kevin. This was really, really very educative about the journey that you had, a very serendipitous discoveries and becoming a kind of a leader of some of the concepts that change the entire financial investment landscape. And I hope this journey of your investments into India also follows the same trend, and wish you very, very best of luck. Thanks a lot for being part of this podcast.
Okay, well, thank you for the kind words, and thank you for the opportunity, and thank you to your listeners for tuning in. I hope they
Thank you.
found it of value.
You've been listening to Investination India. Manish has been a banker, having worked in India for the past 20 years, getting to know investors across the globe, encouraging them to invest in India. Having graduated from IIT Delhi and IIM Calcutta, Manish is the perfect person to learn to invest in India. We hope you've enjoyed the show. Make sure to like, rate, and review. Take care, and we'll see you next time on Investination India.